Happy New Year. What a year we just experienced. Despite uncertainty about healthcare and tax reforms, political scandals, nuclear threats from North Korea, amongst other things, stocks have performed quite well in 2017. In fact, just in the US alone, the stock market has created a little bit over $5 trillion of wealth. All major indices, including international markets, have returned more than 20% last year. Our dynamic portfolio was not an exception. We were up 22%, even though we put some brakes on the portfolio starting in August, when North Korea and the Russian situation was becoming a little bit too heated. One of our favorite pieces of economic data is real disposable income. That is, what's left of your personal income after you pay taxes and inflation is accounted for, together with consumer spending. The last reading released in November shows that both the real income and spending by consumers are growing very nicely. In fact, they are the best reading since 2007. The main difference, though, is that this time, during this expansion, we don't see any excesses like the real estate bubble that we saw in 2007. And because consumer spending accounts for roughly 70% of our economy, our GDP, this is a very bullish piece of data for the stock market. Of course, a 10 or even a 15% market drop could happen at any time. However, the leading indicators signal strength. The Federal Reserve forecast for the US is very bright. The world economy is growing in synchronicity with the US for the first time in many years. Just think of this, the top 30 economies worldwide, they're all growing together now. And the new tax law is expected to raise earnings higher. And earnings drive stock prices because, as I say all the time, they are the mother milk of stock prices. The biggest question mark in my eyes remains the Federal Reserve, which could spoil the party by the end of the year, by forcing interest rates to go a lot higher than anticipated. As always, though, my partner Joe and myself will do our best to remain vigilant. As we do at the beginning of every year, we also look forward to rebalancing all our accounts and revisit some of the investments within our clients' portfolios. So this means that although our 12 asset class diversification strategy stays the same, a few choices within some of those asset classes will be changed. In particular, we have spotted some investments within commodities, large caps, emerging markets, and international bonds. All these 4 asset classes will have different investment choices within our January rebalancing, which we have started this week. A couple of stocks within the dynamic will also be exchanged. Our research is pointing us to look more and more to those companies within the infrastructure and the financial sectors, not just for this year, but also 2019 and beyond. So we would like to take advantage of that. We'd like to add a couple of those to the portfolio this year. One of them is John Deere, a company that we like very much, and it couples quite well with Caterpillar. And the other one is S&P Global. It's another company that couples quite well with a couple of stocks we already have there. One of them is Bank of America and the other one is JP Morgan. In the end, we believe that this solid market momentum will likely continue for at least the first 6 months of the year. And although investors' expectations are quite high right now, we still don't see that euphoria that was so evident in 2006 and 2007 with the real estate market bubble. Nevertheless, we think that investors should maintain realistic expectations for the market. 8 to 10%, perhaps 12%. Okay, anything above that is a bonus in my opinion. There is also the risk for negative surprises. Again, North Korea, tensions in the Middle East, unexpected slowdown in China, They can all call for a negative market reactions. So we don't see these events to happen anytime soon. But again, investors should be very well served to be mindful of such risks. Thank you so much for putting your trust in our firms. And again, if you have any questions, just give me a call, give Joe a call, or drop us an email. Or you can even visit our new Facebook page, which is facebook.com/investinARIS. Thank you so much.